And I think there's going to be a lot of people, it's already started, reaching out and having conversations of, hey, what are you buying in this downturn? What are you buying? What are you buying? And everyone's going to be thinking, oh, this is the perfect time to buy, right? And I think what people are going to use this as an opportunity to market the property they stole from somebody else, and that it's a great deal to buy in the downturn. And they're going to use 2008 as a reference for whether it's a good deal or not is irrelevant. But that's how every deal that's going to be bought in the next 12 months is going to be portrayed.
This is the real estate investing experience. We get it. Real estate can be rough sometimes, and that's why we bring in the experts to talk about the experiences you won't hear anywhere else with your hosts, John Cohen and Chris Grinzik.
What's going on, guys? Welcome to a special edition podcast of the real estate investing experience. We are working from home today. I'm your host, Chris Grenzig, not across from me, teleworking, but also somewhat still across from me, co-host John Cohen. How you doing?
Hanging in there. I was on the phone the other day with somebody, and I was saying that right now, knock on wood, this is fun for me. I mean, I get to stay home with my daughter. I get to stay home with my wife. My wife cooks lunch every day. So it's like now I get home cooked dinner, home cooked lunch, and I get to hang out with my daughter and my wife. So I have –
You're spoiled, unlike me.
Oh, spoiled beyond belief, and I have no complaints yet.
Until the baby goes crazy, and then she's not going to stop crying.
Mm-hmm.
Yeah, I'm not like you. I'm by myself.
I know you're in a house by yourself. That's got to be tough.
And I'm all the way out east, so I don't even have Brooklyn to go out and walk around and enjoy. I don't know. I got to find a park or something. I don't know what I'm going to do.
They just closed parks too.
Yeah. Well,
except you could walk around.
No, I know. But anyway, without getting too much into it, we wanted to do a special podcast, just you and me, for everybody listening, just to kind of touch base and give some of our, I guess, thoughts or ideas or what we're seeing going on with, the coronavirus and all the stuff and how it's going to impact real estate, or who knows what it's going to do. So we wanted to do a quick, 30-minute podcast, maybe 40 minutes, depending upon how long we go. Just kind of giving you our thoughts today. Right now it is March 23rd. It's a Monday. This will probably be out inside the next 24 to 48 hours, but just in case something changes overnight and it completely throws this out of context. But, as of Monday, that's kind of where we are. We're taking it day by day, week by week. This is going to be a really fluid situation, and, we'll kind of just see, how it's going to happen. I don't know if you want to throw in your 2 cents before we just start getting into it.
Yeah, no, I think, I can't disagree with that. I think, anyone that says that they have a crystal ball, and I don't think anyone is, but,
no.
The impact to us and our business, and we're going to get into it a little bit more, I think time will tell, because we're still 8 days away from the first of the month when rent's due.
Yep.
So I think we're going to give you our thoughts, opinions, and, we've been talking to managers and we've been getting updates. We've been speaking to everybody in the business, but I think, time will tell, but we're going to, we'll put our 2 cents out there like everybody else. And I think it'll be helpful. I think people will like it.
Yeah, for sure. So reached out to a bunch of people in our network that, that are following the podcast and us and stuff like that, ask some questions. And, one of the questions, and I think a good way to kick it off will be quasi what we've been, telling all our investors and stuff. But obviously, like you said, first of the month's coming up. Everyone's on their mind, collections, and our tenants going to pay. So why don't you kick it off? What have we been discussing internally on collections, on rent? What have we been telling investors? What have we been doing to kind of prepare for, 7 days from now, a week from now, and the first couple weeks of April?
Yeah. So I think, the easy answer is, when it first happened, we're local to probably one of the worst situations in the United States. I think that, we're probably on the front line. I think that the rest of the country will feel it 10, 14, 30 days.
You're talking about New
us.
York, right?
Yeah, New York.
Okay.
So as everybody knows, we don't own anything here.
Mm-hmm.
The one property we own is a small mobile home park with all retirees that basically pay with Social Security and fixed income. So we've actually already collected 100% of our rent for April. They mailed checks in. So that's the only immediate impact we have in New York. But across all sites, we've done what everybody else has been doing, shutting down amenity space, virtual tours, only emergency maintenance. We've put all the precautions in place that the CDC has recommended. But for all our properties right now, we are operating business as usual because there's been no lockdowns. There's been no immediate, anything like that. So we're still showing apartments. We're still touring apartments, virtually, not physical connections, but we're doing, virtual tours. I think there's only like 19 cases in Jacksonville. I know that off the top of my head. Ohio's been hit a little bit harder, but right now it's business as usual. I just got off the phone with our manager in Jacksonville, and we're still, we're still leasing apartments. We're trying to move people in before a potential shutdown or anything that happens. But right now, we're doing what the CDC recommends on all sites. We're anticipating collections to be way less than a normal month, but we are expecting people, and we're requiring people pay until further notice.
Yeah. I think just quickly break down where all our properties are so people understand what areas we're talking about.
Yeah, so we have a property in Wilmington, North Carolina. We have properties in Jacksonville, Florida, about 1,000 units in Jacksonville, about 1,000 units in Columbus, Ohio. We have a property in Mobile, Alabama. We have a student housing project in Tennessee, right outside of Nashville. That's it.
South Carolina.
Oh, and yes, we have a property outside of Greenville, South Carolina that's under due diligence, and that has been delayed. That should be something we could talk about. That'll be a fun one. But in the midst of contract negotiations and contract signing, we had to put a day-by-day pause. But we can get into that a little later.
Yeah, we can. No, I think it's really interesting to see what's going to happen. I think we were talking this a little bit before we started recording. It's some people are definitely freaking out way more and are expecting 0% collections, and I think some people are significantly less worried. I think I definitely fall closer to the significantly less worried because, what we were just talking about is, what is unemployment realistically going to drop to? Is it going to drop to 5? What is it now? Like 3% before this all started, right? Or like 3.5, 4%, whatever it was. Was it going to drop to 10, 20, like 30%? That means, the rest of everybody else should theoretically still be working, even if it's from home. So that would mean they should be able to pay. I guess the worry is if they're putting a eviction halt across all these areas, how does that affect people who are still getting paid, wanting to pay rent and thinking they can get away with it? So I guess it's a little bit of a mix of two. I'm a little bit more of the way of like, I think if somebody can pay, they're not going to want to get into any sort of like credit situation or have to owe it in the future. They're going to pay because it's where they live. And I think a lot of tenants understand that, you just pay rent. Do I think necessarily it's going to be the easiest collections in the world? No, probably not. But, a lot of people are still working right now. And a lot of people are getting relief as well. There's a lot of companies out there that are offering a ton of relief. So I'm a little bit more optimistic than a lot of people. But I am curious to see how it's actually going to play out.
My emotions have gone up and down, right? I was walking, I was taking a walk around the block and I'm like, wow, there's a chance that, we have $100 million worth of loans, like nobody pays rent, right? Like
True.
That's something, you lose a little bit of sleep over. But then on the same time, I don't disagree. Listen, I think that there's a really good article in CNBC and, we're going to get out our newsletter this week and it'll be in there. And I recommend everybody, look at it. It shows basically bear and bull markets going back to the Depression. Do I think we're in the Great Depression? No, I think that's fucking crazy. Yeah. Do I think that tenants are going to take advantage of the situation? Of course. I mean, in our space in particular, the B and C class product, the tenants are going to take advantage of it and we're preparing for it. We're expecting it. I know one thing that I've done for the last week is we've gone out and I've brainstormed a million ideas. There was an article that I got that Publix is looking to hire over 1,000 people in Jacksonville. Mm-hmm. I sent that to my manager and I said, and our manager's father or our manager's father's best friend is like the in charge of human resources for Publix. I sent her that link and I said, listen, tell all the tenants if they get hired at Publix while Publix is looking to hire, we'll waive their April rent or their May rent. So we're trying to help our tenants that are going to claim they can't get a job or they've been fired. But, we also rent to police officers, firefighters, retail workers, um, uh,
Military.
military. We rent to jobs that are still working.
Yeah.
Do I feel bad for the short order cook at McDonald's? Yeah. Do I feel bad for the waitress? Of course I do, and I understand those situations, and I'm not trying to diminish it, but we're going out of our way with different approaches, to the point of sign a renewal now, get your April, pay your April rent, we'll waive your May. Or, thinking about creative ways to use their security deposits to stipend their rents and then have their security deposits build it up over the next 12 months. But we're anticipating the worst, preparing ourselves for that. But I think that we're going above and beyond, trying to work with our tenants and help them and guide them and point them in the right direction. Because listen, there's still going to be delivery drivers. I'm getting a package every day from Amazon.
Yep.
I'm picking it up with a tongue, but yeah, I mean, listen, you have to expect the worst, but you hope that people are good by nature, and then they pay, and that's all we can do. And anyone in this space that thinks they know what they're talking about, they're wrong. They have no idea. There's been nothing like this over the last 20 years. I'm in a mastermind group where people talking about bird flu and swine flu and all these other things. It was not like this, and I didn't think, I think there's going to be a little bit of work. I think it's going to be a kick in the teeth, but you gotta get up. So we'll go through it. We'll figure it out.
Yeah, I think a succinct way to kind of put it is, we're in the middle of a lot of different groups, right? The banks, the tenants, the managers, the people we employ, the tenants, our investors. We're just trying to find a way to help mitigate any losses that all those people are going to suffer, right? Banks are going to suffer a little bit. Tenants are going to suffer by loss of jobs. Managers are going to suffer from extra work and headaches and dealing with tenants. Investors are probably going to suffer, whether it's just, halting distributions or lower cash flow or, just worry about what's going to happen. So I think we're doing everything we can to try to come up with a solution that helps everybody. And just remember that, this is where people live. And then this is also, people's, money and capital and stuff like that too. So it's not easy by any means. And that's why I said it's fluid. So it'll be interesting to see, kind of where it goes. And I think it'll be interesting to see over the next couple weeks how some of the debt relief stuff that we've seen on the residential side trickle over to the commercial side and how much they're going to be willing to work and forgive and, what kind of stuff they're going to roll out to kind of help, other commercial real estate owners.
I think it's going to be interesting. It's definitely, what's the word? Not exciting, but you're sitting on the edge of your seat. It's like an exciting feeling, sort of, what is going to be, what is going to be the solution? Because, there's a potential it can get pretty bad, but I do also have to caveat, and this is not just because it's what we do, but I personally believe that, in a downturn that could potentially be on the horizon or not, besides sitting in cash under your mattress, a good submarket, a well underwritten, solid property, I don't know where I'd rather be with something, with the stock market down 30%, where I'd want to be is in a physical asset that's been, in a very good submarket that's sitting there poised for maybe not the next 30, 60, 90 days, but the next 36 months. Yep. So, that I do still truly feel, extremely excited about, to see what happens after this.
Yeah, I think definitely one of the things I'm trying to be cognizant of, and it's something I've definitely struggled with earlier on, but been better at, is that, these are not short-term projects. Even our short-term projects are, a few years. And some of our projects are 5, 7, 10 years. And it's, everything I've seen and, the way everybody's spoken is, this is probably a few months, maybe it's 2, maybe it's 6. Obviously it's not going to be, back right up to where it was like a snap of a finger. It's going to take some time, but, it's jobs stop because people can't physically go to work. It's not like the economy tanked or something happened where people truly lost income. It almost feels like a halt rather than a stop or a shortage. Yeah. So, and look, I'm sure there's jobs that are not going to just bounce right back, right? Like the cook at McDonald's, jobs probably going to be there when they're allowed to open up doors again and people are starting to come back in. Will they need as many workers day one? Probably not, right? Because people are going to be more wary to come out. But in 3 months after the quarantine is officially over, or whatever you want to call it, I'm sure it's going to be back to business as usual. So I do think there's going to be a somewhat, in the big picture, grand scheme of things, a pretty quick rebound. It's going to be more of a V than a check mark where it's going to take time to kind of pop back up. So if you think about it, from that kind of thing, I agree with you. I think real estate's a great place to be in, because over the next 5 years, I don't see it being hit too hard, except from, a couple different areas, which we started talking about, but maybe this is a good segue to get into. One of the other questions we had was, what are your thoughts on impact from the virus, short-term and long-term? And we kind of already started talking about it, obviously, just from a real estate perspective. But what's some of the stuff you see short-term besides collections? Because we just talked about that and people being able to pay. What do you see short-term? And then what do you see, let's say inside the next year, we'll say short-term, and then long-term, anything over a year to, 5 years or something like that.
Yes, I think short-term, the 800-pound gorilla in the room. What happens April 1st? That by far to me is going to be the biggest telltale sign of what's to come. If everyone stops paying rent, yeah, it's going to suck for April. It'll suck for May. It'll suck for June. But, Chris, you're 100% right. It's going to get back to normal, right? This is not 2007 to 2009. This is not that situation. It's not, there's not big financial banks crashing, right? It's not, they didn't, maybe there's an underlying thing here and they're right in bed mortgages and stuff like that, like they did. But I do believe that, the other short-term factor is that, let's say you own a business and you fire 80% of your staff because you just can't support it. Well, guess what? Your competitor is doing the same thing.
Yeah.
Because if you're selling, not that this business is going to be at risk of getting fired, but if you're selling apples and there's not a need for apples anymore, everyone's going to fire their staff. So what's going to happen 3-6 months from now, or a month, 60, 90, 120 days from now, when the world gets back on its feet, all those people are going to need jobs again.
Yeah.
So it's going to be a shot. It's going to be a quick pickup, in my opinion, the short term. Do I think the next quarter is going to suck? Of course I do. I think it's going to be brutal. I think that, distributions are gone. I think that, and now listen, if you have the money in the bank to make a distribution, I don't think it's smart to do it because you don't know what the long-term effect is yet. So in my personal opinion, I think the next 3 to 6 months are going to be tough. I think it's going to be like anything else. We're going to get kicked, but we're going to get back up.
Yeah.
Do I think the repercussions of a year and 5 years are going to be detrimental to the real estate space? I don't. If anything, I think it's very positive, but I do think this is the domino. We've been on a bull market run for 11 plus years, since 2009, it is when it started. And it's just been it's sort of how the coronavirus is spreading, right? It's been an exponential growth for 11 years. So I do believe that this is the domino to, wake people up, not unsimilar to this business where there's a lot of new people getting involved, a lot of new, 4 or 5 groups coming together because they can't really raise it. They really don't have the balance sheet. I do think this is the, one domino that could fall as an excuse for, banks, for, buyers, for that whole industry. I think it's a way for banks to use this as let's underwrite to a higher cap rate. Let's just be a little bit more conservative. Instead of doing 80% leverage, maybe only 75, right? So I think the 12 to 24 month impact, I think will be much larger than the 24 month to 60 month. I think once you get to 24 months, people have a short-term memory. Yeah. And I think that will go away. But I think the next 24 months, we buy 3 to 5 deals a year. Could I see us in 2020 buying 1 more property? Yeah, maybe 2, but I could easily see us scaling back just because maybe there's not as many sellers, or maybe there's more sellers because there's fear, and now because there's more sellers, it's supply and demand. There's so many properties, you could pick the best one. But fundamentally, short term is going to suck. I think 12 to 24 months, it will be slower. 24 plus, I think will be fine. But let's call a spade a spade. there's still millennials are a huge demographic. Gen Z and Gen Y, there's still so much positive economic signs, right? There's still a lot of growth. There's still a lot of baby boomers that are going to be downsizing into apartments, into old age homes. There's still going to be housing that's needed. So do I think this is the end of the world? No, I don't. I think that, everyone has to go into it eyes wide open, understanding that, the near term, from, the next 90 days, be a little leery. But, if a really good deal came across my desk, I would dive on it. I mean, I would, if it was really good, I would still look at it the same way I'm looking at deals now, just, making sure it checks off all our boxes and is fundamentally strong. And if it's fundamentally strong, it's going to be strong.
Yeah.
Would I be going out and doing heavy levered 90% bridge loans on vacant property? Probably not. Mm-hmm. But, a good deal is a good deal. And, even in the downturn, there were deals being bought in 2009 and 10 when people thought the world was over. So I think the 24-month picture here is shitty, slow, and then we'll be right back on our feet.
Yeah, I agree with a lot of what you're saying. I think it's actually going to happen a little bit quicker. I think people's memories are significantly shorter than 24 months. And I think there's going to be a lot of people, it's already started, reaching out and having conversations of, hey, what are you buying in this downturn? What are you buying? What are you buying? And everyone's going to be thinking, oh, this is the perfect time to buy, right? And I think what people are going to use this as an opportunity to market the property they stole from somebody else, and that it's a great deal to buy in the downturn. And they're going to use 2008 as a reference for whether it's a good deal or not is irrelevant. But that's how every deal that's going to be bought in the next 12 months is going to be portrayed is, messed up financials because of Corona. And we're going to come in and clean it up and we're going to operate it better over the next, 36, 72 months, whatever it is. So I'm really curious to see what, buyers' expectations are going to be like and what sellers' expectations are going to be like, in the next 3 to 6 months, because everybody's financials are going to be crazy. So it's going to be, what is the debt even going to look like? If you've got 20% bad debt, let's just say hypothetical, you're not going to be able to get, every deal you get underwritten, broker puts in, market expenses, market occupancy, right? Can't throw market occupancy on there when it's 20% bad debt and expect to go get 75, 80% debt. You're going to get 60% debt because you're overpaying for it, basically. So it'll be interesting to see how deals trade in the next, 6 to 12 months, and how bad it actually gets. I do think, though, that we're going to move right back into where we were. The last 12 months, I thought, a lot of things were definitely overpriced and people were very aggressive on underwriting caps and underwriting vacancies and expenses and, high leverage and stuff like that. I think we'll be right back there inside the next, not inside, but right at around 12 months. I think people are going to be like, oh, that wasn't that bad. Like, if that's the worst that's going to happen, we can get through anything, or some sort of bullshit like that. So it'll be interesting to see how people change. I do think there'll be a stronger push, though, for going back to the deals where you go in, you take care of the deferred maintenance, and you just go 5 to 10 years and you try to hit a 12. You're not trying to hit a 25 IRR. You're not trying to hit a 10% cash flow. You're just going to come in, buy a quality product in a good area, not over leverage, like you said, 65 to 75% debt, and you're going to look to hit a really safe, solid return of a 12, which I think, because of so many deals that have traded hands over the last 2, 3, 4, 5 years that have been levered at 80%, and people have hit ridiculous returns of 30s and 40s and 25s or whatever you want to call it. People's expectation just went higher and higher and higher. I think there's going to be a kind of a reset button on expectations as a lot of people get hurt and have to deal with paying debt that they can't afford now over the next 6 months, where we're talking about a relief program. If, banks let them pay 50% of their mortgage, or 80% of the mortgage, or 20%, and then they've got to make that up over the next 6 months, or they tack on an extra, 6 months on the back end, however they structure it, that's going to hurt that deal substantially more than the deal that was levered at 70% with fixed rate interest. So I think there's going to be a lot more demand for, lower levered, solid deals than, there has been over the last 3 years.
So that I agree with Hunt. I think the next 12 to 16 month months. You're right. I don't want to say that this was the kick to the teeth, but a 12% return is a good deal.
It's
And
great.
I just think everyone's eyes have been blurred by doubling your money, tripling your money, making it 30, right? I think that this is that reset button you were talking about, that I think that if you can get 12% on your money annualized over a 5-year hold, 10-year hold, whatever it is, that's a phenomenal deal.
Mm-hmm.
As far as diversification goes, if you have something wrapped up into that 12% return, good real estate, I mean, that you can't ask for anything more than that. So I think that's spot on.
Yeah.
And I think that with social media and technology today, people's it's short-term memory. It's in one ear and out the other so quickly that I think 12 to 16 months from today, not 12 months after whatever happens. I think 12 to 16 months from today, that's what used to be 36 months 20, 30 years ago, because I think that there's so much bombarded in front of you that it erases your mind so much quicker. So I agree.
Yeah. One positive that I do think is going to come out of this is, we definitely have some employees in the management world, whether it's corporate office or on site, that struggle to implement, and tenants too, struggle to implement some of the technology that a lot of properties are bringing on. Not, A properties, B plus properties, not so much, right? Your B minus, your C's, your C minus, class stuff. I think because people are going to now be forced to have to use a lot of this technology, like we're forcing all of our tenants, all maintenance orders through, online resources, all leasing through online resources. I think you're going to see a lot more people start to adapt that. I do think that will be a unintended positive that we'll see in the next 12 months is technology is going to be easier to use across all your properties.
No, without a doubt. When I hung up with our manager in Jacksonville, it's $24 extra a month to get everything virtual tours, So we just did it. I mean, I approved it today because, to lease, if this gets really bad and there's a lockdown for 90 days, well, okay, people can't move out, but listen, like anything else, people will do things they're not supposed to do. And if you live in a building that gets infected and you have to move out, are you just going to go into buildings? No, you're going to do everything virtually. So I think that is an unintended positive of this thing, is that now people will be forced to use technology. So I do think that's really compelling to see how that shakes out for operating C and B class properties, which have historically been a little bit difficult to, turn on technology because some tenants don't have bank accounts, or, they don't want to use the portal. They want to pick up the phone. So I think it could be a positive.
Yeah, for sure. Next question. I'm not going to use it word for word, but in terms of setting money aside for reserves to cover, loss of income, debt service, what are you thinking? What are you suggesting for anybody that, owns their own stuff? Or, what are you thinking we're going to do for our own properties? Is there certain expenses we're going to, delay? Are there certain tactics, you're thinking about potentially implementing, stuff like that?
Yeah, I'm putting everything into Bitcoin. No, seriously, but realistically, you pay the necessities, right? Mm-hmm. If we get 100% collections, we're paying bills as normal. If we get a 60% collection, you pay the stuff that's important. Everyone should be on the phone with their banks now talking, what's the plan? What's the contingency? Can we add the payments on? And then you work your way down, right? A contractor that turned a unit, am I saying we're not going to pay them? No. But, I know that guy probably needs the money more than the water bill, but you got to pick and choose who gets paid. The only thing that I told all our managers is, first and foremost, the mortgages, right? That's the first thing that's got to get paid. We'll figure it out after that. Luckily for us, we go into all our deals with extremely good cash positions. Mm-hmm. We have cash in the bank. So like I just got an email, one of our properties, we just put our third draw in, and the email was, we're officially tapped out. I said, can you lay out some money? I said, well, let's get the draw in. We'll float it for a little bit out of the operations, but let's scale back our renovations. Let's get that draw money and let's focus our attention towards, the mortgage. But, in times like this, water bills, electric bills, sewer, those companies they're going to get crushed because people are not going to pay that stuff. Food for your kid is more important than paying your gas bill, right? And
Right.
I know where we live, the electric company already said, they're deferring payments. I mean, there's mortgages that are being deferred. So the first thing that everyone should be doing is, in my opinion, getting on the phone with the banks and seeing what the bank's willing to work with you. We just got out the phone. We have a student housing deal. The first thing he said, without even having a conversation, was, I'll drop interest only for the next couple months. Now we're going to go to him and see if we could defer one payment or something like that. But first and foremost, pay the mortgage. And then you look at your bills. It's like anything else. You look at your bills, you prioritize them, you pay the ones you can. But I do think that cash is king. If it means not paying a bill and keeping a little bit on the side for a rainy day, that's what I would do on a smaller deal, right? On a duplex, on a single family rental, on a 5-unit. I would probably err on the side of having some cash reserves, and then, start working on my bills that I personally believe I can get some relief for. But I would also, reach out to everybody and say, is there a program you're doing? What programs are available to me? The federal government is passing bills and not passing bills literally by the minute.
Yeah.
So if you're in real estate, or if you are, an investor of any sort, you should look to see what programs are out there. Our accountants have been updating us with different types of programs, and I've been applying for stuff and getting not approved because we're not qualifying. But you got to go out there and see what's available for you, so you can at least have your plan in place when, a bill comes up and maybe you can't afford it, maybe you can't. But the only thing that has to be paid is the mortgage. Personally at Toro, we've deferred all asset management. Obviously that goes without saying, but we've put a pause on that. We even spoke to our managers about, potentially deferring some management fees. But for the most part, the number one thing that I said to everybody was mortgage. We'll figure it out after that.
Yeah. No, I think it's important, right? Mortgage obviously has, essentially a lien on the property if you don't pay. So that's got to be covered. And then I think, utilities, everybody needs that. Like you said, I think a lot of places are going to start deferring that stuff too, like New York. I think, so like Raleigh did it as well. I'm sure some other places in the Carolinas have. I'm sure at some point, if it gets similar to New York everywhere else, that'll be one of the things, they just start deferring. So, those are some things you can put on the back burner. I think, you can start deferring things like, landscaping, right? Switch it from every 2 weeks to every 4 weeks, right? I don't think a tenant's going to complain for 3 months if their grass is a little long, right? Like, marketing, maybe you can scale down that, so, CapEx reserves and things like that. You don't necessarily have to spend, right? Fix the black appliance instead of replacing it, things like that. So I think there's a lot of things you just, like you said, got to prioritize what's the most important, see what you can work out, and, just kind of work backwards.
Exactly.
So that's all it is. I think last question we have, and then we'll kind of wrap it up, was what are we going to do going forward for new deals? So like what assumptions are we going to do for underwriting? How are we going to look at rent growth, vacancies, reserves? And I'm going to break this up again into short term and long term again, because I think it's going to be two very different things.
Yes, I think the immediate thing that my reserve on new deals is, and I, Chris handles a lot of the acquisitions, and the immediate thing is, if we found a really good deal today, unfortunately, I can't go look at it, right?
Yeah.
The one thing that we would never do is buy a deal we haven't seen. So right now, for new deals, sourcing new deals, my immediate fear is on the bad debt and the tenants. I'm looking at every deal right now as whatever's in bad debt is being 100% written off, because the eviction costs are basically on pause. So what do you think's going to happen when they get back in action? The backlog is going to be out of control.
For sure.
So if you look at that tenant ledger and you see a tenant that has historically paid day in and day out, and they went delinquent because of this, well, one, look at where they work and what they do and say, okay, this tenant, once they get back on their feet, you're not going to have a problem. If you look at a tenant that has historically been late, maybe their job's more, not secure, that's something you want to consider going forward with the eviction on that guy. But you're going to have to be flexible there. So I think in the immediate future, any deal I'm looking at, I'm looking at the bad debt and really understanding the bad debt. I got off the phone earlier with someone else, and I said new deals right now. Opportunistically, if a deal came across my desk that I could act fast on, I would. Within reason. I can't get on a plane and fly somewhere, but I do have contacts throughout the country, so I would use my resources. A good deal is a good deal, as I said earlier, but I do think that really paying attention to submarkets is going to be more important over the next 12 months. As we go a little bit longer looking, I think this goes into one of those situations that, if it gets bad, there's nobody, maybe Bill Gates, but other than him, nobody saw this coming, right?
Yeah.
I don't care, any sponsor out there, any owner, any investor, they could say they've been sitting on the sidelines because they think something's going to happen. They did not think there was going to be a, virus pandemic, right? That, I'm sorry, it's just, I don't believe someone out there, was saying, oh, I'm not buying multifamily because nobody's going to pay their rents when the coronavirus hits the United States. So I think that in the immediate future, you want to understand your bad debt. You got to remember market fundamentals are still strong. So vacancy is vacancy. Rent growth is rent growth. Job growth is job growth. That stuff is factual. Mm-hmm. There will be job growth. Jobs will come back after this. So I think, good markets are good markets. The one number you just want to understand is bad debt. Was it bad debt because it was a tenant that was going to go bad? Or is it bad debt because, the guy was a waitress or the girl was a waitress and they couldn't afford it, right? That's a different type of bad debt. So I think the immediate concern is bad debt. I think the longer term concern is location, and you want to be fundamentally strong. But I think the one biggest thing that and we've been doing it for 12 months, why we haven't bought a lot of deals or why we're not competitive in the Carolinas as we used to be. Even in the office, I'm the one that says, 6 cap, use a 6.25. Am I going to say I'm adding 50 basis points to our cap rates on sale? Absolutely not. But just be aware. I mean, we've seen deals where people are literally selling them at sub 6 caps in 6 years. I think it's fucking crazy.
I started seeing it at sub 5 caps. Remember, there was the 1 or 2 we saw right before this happened. I was like,
yep,
that's new.
Yeah, those deals only work with interest rate help. So I think you just want to stress, we're still going to use the same metrics we've used always, but you're going to put a little added weight on stress test. I think the perfect example is a deal we're buying next Monday. It's a deal that, it's been going on since October. It's a loan assumption. We have I've stress tested the deal up to a 7 cap, a 7.5 cap, I think, in Jacksonville. And, I think at a 7.5 cap, it's still like a like a high single digit IRR, like a 9 or an 8 and the cash flow is still solid. So I think that, and it's fundamentally rock solid. It's in a great location in Jacksonville. I think that the rents are low. So tenants, it is what it is. But it's a deal that I truly believe in. We were on a call earlier, internally at Toro, earlier before today, this morning. And I said, if I had the money, I wouldn't even offer it up to investors because I think as far as security and what it is, that's it. You just want a really solid location, fundamentally sound deal that's got a stress test, oh shit scenario that still supports itself. And that's sort of how I'm looking at the immediate, the moderate, and the longer term.
Yeah, no, I agree with a lot of it. I think paying attention to why people went delinquent in this, 3-month window, let's call it, is going to be very important over the next 6 to 12 months. I do think it's going to be tough to find deal flow inside the next 3 months because, like you said, it's for us to buy a deal without going to see it prior to and relying on somebody else to go see it. It's got to be, it's got to be a pretty good deal. We've got to feel pretty confident. It's got to be an area we know in really well too. So there's only so many places it can be. It's not going to be like in Atlanta, for example, because we don't own anything there. You were invested in one deal there. So it's not going to be anything we look to take down because we can't go see it. So I think that is definitely going to play out. I think long-term, one of the plays I still liked, and we looked at several of those before this kind of happened, was doing more loan assumption deals, really good submarkets where, because interest rates 2 to 4 years ago were, mid 4s to high 4s, you're going to buy stuff in, high 5 caps or low 6 caps. And it's going to be really well preserved from that side because you don't have to underwrite to a 5 cap in 7 years. You can underwrite to 6.5 cap, and they'll still make a 12, a 14, 16 maybe if it's a good buy and your debt's going to be fixed. It's going to be, 70%, 4.5%, fixed interest rate for the next 5, 7, 8 years, whatever it may be. So I think short term, I think that's going to be really interesting to see how that plays out. Because we're not going to be sure what the debt world's going to look like over the next 6 months. Our spreads are going to come back down. Our interest rate's going to come back down. Are they going to do interest rate hikes once this kind of all comes out with the Fed? So it'll be interesting to see what happens. I think one thing we'll continue to do that we've been doing for the last 12 months is jacking up our below the line CapEx. Everybody says do, $250 or $300 a unit. We've been doing $500-$600 on almost all our deals. Maybe not in the first year, but in the second, third, or fourth year is when we'll start. So I think that was something that I really liked that we've been doing. So I think we'll probably continue to do it. I think, like you said, stress test, because, if the market corrects and comes back to close to where we were, your vacancy is not going to be 10%. So if you underwrite the 10% vacancy in a 5% market, you're not going to buy anything, or, you're going to be wrong somewhere else. If bad debt in the market is 1%, you underwrite the 10, you're just not going to buy anything, or you're going to have to find the perfect deal of all time. And you're just buying it for, way under market value, and you're not going to own it for 7 years because you're going to flip out of it. So I think as long as you can stress test and understand what the downside is, what's your break even occupancy, what is your debt service coverage ratio, what does it look like if you stop, market growth increase on rents and expense growth and things like that. What does it look like at an 8 cap? As long as you can understand that and feel comfortable with it, I think there's only so much you can do if you want to continue to buy deals in the next, call it 6 to 24 months. If you want to get super aggressive, maybe you go to tertiary, really small markets, and you can, do some of that stuff, but then you're more at risk. So, it's all a game of give and take. The more you give, the less you're going to take. So, you just got to understand what you're getting yourself into. If you're really worried, go lower debt, go 55, 60, 65% and, be super conservative. But other than that, there's only so much you can do. So I think reserves and stress tests is really, the two biggest things.
Yep. CapEx I didn't touch on, but I think that's going to come up to bite everyone in the ass. And we put very healthy CapEx. We've owned deals. We've operated deals. We know really what it costs. I think CapEx is an underutilized and underspoken about thing. So I'm glad you brought that up.
Yeah, I think it's going to be really interesting to see how people start valuing deals within the next 18 months for, those deals that have sold 3 times in the last 6 years, that everyone's just continued to do the same interior renovation plan, or they even stepped it up and did a luxury edition or a premium edition of that. And nobody's done the roofs. Nobody's done, AC condensers. Nobody's, done the little basic stuff that needs, the piping, it'll be interesting to see how that stuff kind of plays out. And that was kind of, our whole episode with Chris Jackson that we spoke about that, but it'll be interesting to see how that stuff plays out. I think there'll be a lot of people that are going to miss because of that stuff. I think more people are going to be way more cognizant of that and be way safer in that regard. And people are going to find themselves hurting because they didn't take care of it. So that's really it for me. You got any final thoughts you want to leave it off with?
No, I think final thoughts is, I think time will tell, right? We're talking here from what we think, but time will tell. And then I'll just leave, I've gotten challenged a lot by everybody on this 10 push-up thing. So I'm going to start my push-ups after this, but anyone listening, 10 push-ups. I suck at social media. Chris is good. Send it to him.
I don't do the challenges.
But let's have some fun with it. Let's look at the glass half full, right? Because I think there's enough negative out there. So fuck it. Glass half full.
Yeah, for sure. Awesome. All right. Thank you guys so much for listening. If you're not subscribed already, go and subscribe. It would really help us out. We're also thinking about possibly doing this on like a weekly or bi-weekly basis, just as this goes through. So if you think it's a good idea, let us know. Maybe we'll bring somebody in to talk about it too, get some other opinions, some other input. But yeah, that's it. Thanks for listening.
Thank you guys.